Hey everybody, Tim Doehrmann back today to chat a little bit more about limiting lifetime tax liability. Did you know that there is a way to pay zero taxes on capital gains? That's right, zero. Well, it is possible, and in this video, I'm going to break down the insights into a strategy that could potentially help you pay no taxes on capital gains. So, I know what you're asking. How can you pay 0% on capital gains? Well, there's this little known tax benefit in the US tax code, often referred to as the 0% tax rate on investment income. And this provision has actually been in effect since 2008, and it allows certain individuals to pay no taxes on their capital gains and their dividend income from taxable investment accounts. And despite its existence for over a decade, many taxpayers are unaware of this opportunity. As I have mentioned in other videos, there are ordinary income tax rates, which is our 7-bracket system, and there are, of course, the more favorable rates of qualified dividends and long-term capital gains. The 3-bracket system, right? And these are preferred. These are lower than ordinary income taxes, and they even start with the 0% bracket, right? So they're preferred. Now, to qualify for this 0% tax rate in 2023, single filers are going to need to have an income below roughly $44,000. And if you're joint filing as a married couple, then you're going to need income below just under about $90,000. Also, obviously, we're going to have adjustments to taxable incomes, right? Such as standard deductions. And this can also expand the portion of your income that's going to be subject to this rate. For instance, if you are a single filer, you could potentially have up to $58,000 of capital gains or thereabouts and dividends taxed at 0%. While if you are married filing jointly, you could have almost $117,000 in this 0% bracket. So utilizing this 0% rate can be beneficial for individuals experiencing lower taxable income periods, such as those that are maybe between jobs, or maybe if you're an early retiree and you have not yet begun to take Social Security or your pension or your IRA withdrawals yet. Of course, RMDs, right? The tax bomb that I've talked about in other videos. However, not all taxpayers are automatically going to qualify for a 0% rate. There's a stacking rule that requires eligible income to be added on top of other income, potentially reducing the benefit for all higher income individuals. Now, as a result, careful planning is going to be necessary to take full advantage of this tax savings opportunity. Now, I have already talked a little bit about tax loss harvesting in another video, but this is basically the opposite of that. This is tax gain harvesting, where we're trying to fill up a 0% bracket by selling an investment with a long-term capital gain and then buying back the same investment, if we don't want to swish it up, in order to lock in those gains at a 0% bracket. And of course, why would we want to do this? To lower lifetime tax liabilities. Okay, let me give you an example of how this might work. So let's say that we have a married couple and they just retired and they owned Caterpillar stock for a long time. And of course, they want to keep owning it, but they're sitting on about $200,000 of long-term capital gains. Now, let's say they're not going to have any more earned income in 2023 because they retired recently, and they haven't flipped on Social Security yet, and they're relatively young, so they don't really have to worry about required minimum distributions for over a decade, and they have a lot of cash in the bank. So they're just going to be able to use that money for living expenses this year. Well, we're going to sell enough Caterpillar stock to lock in $117,000 in long-term capital gains. Then we're going to buy it back the next day. So now they still own Caterpillar stock, but they just locked in a 0% tax rate on $117,000 in long-term capital gains. So, not chump change. Now, sometimes people ask about the wash rule. Maybe you might have heard of the wash rule, maybe not, but what the heck is that, right? Well, the wash rule states if an investment is sold at a loss and then repurchased within 30 days of the initial loss, it cannot be claimed for tax purposes. But the key word here was loss. With tax gain harvesting, we're actually selling with a gain, not a loss, so the wash rule does not apply. Now, the decision to use the 0% rate should depend on individual circumstances and, of course, financial goals. Now, factors like the size of the taxable retirement accounts, expected payouts, annual expenses, and, of course, federal and state taxes are going to play a significant role in making this decision. Younger taxpayers can also benefit from the 0% rate if they have eligible gains or dividends before reaching their peak earning years, especially if they're going to have investable appreciated assets, right? From my own perspective, being able to pay potentially a 0% on capital gains can have a significant impact on your overall financial well-being, especially as you plan for retirement. Again, we're trying to limit lifetime tax liability. But there are going to be a few things that we have to remember. First, capital gains stack on top of ordinary income. And in the next video, I'm going to talk to you about what happens when you have ordinary income and then you stack capital gains on top of that. Now, second, you have to remember everyone's financial situation is, of course, unique. So it's always a good idea to consult with a financial advisor or a tax professional to tailor these strategies to your specific circumstances. And of course, we always want to pay what we owe to the IRS, but we never ever want to leave them a tip, right? So as always, thank you for tuning in, and I'll talk to you soon. Once again, Tim Doehrmann here, founder of Eagle Ridge Wealth Advisors. And if you would like to see how we help our clients get the most out of their financial lives in retirement, please visit us at erwealth.com, and we hope to see you there.